in terms of if it is that is used when you have your output. It's an output based industry. So say, suppose if you are a scooter manufacturing company, so your index can be number of scooters manufactured per day. So cost per scooter so much. So how you can measure the output value in monetary terms. But then if it is services or some other type of business, then there is no fixed output in measurable in terms of numbers. So then you come back to turnover. So depending on the business activity, which is being carried on, you have to select what is the index of activity for the purpose of LOP.
Perfect, sir.
Yeah.
So let us proceed further from turnover to other things. Ashok ji.
Yeah, in our Maharashtra, election results are out, so already outside there are, people are with Dhol and Tasha.
Who is winning as on date, as on this moment?
Looks like Mahayuti, the existing dispensation is winning.
I see.
Big time, I think.
Yani Mr. Sindhe and the BJP.
They are winning. Yeah.
Looks like. Today I have forgotten that 23rd was. So coming to our things. So Ashok ji, what does sum insured covered under LOP policy cover represent? I mean, see, in basic policy, in material damage policy, we talk about restatement cost, restatement of by new item, any item of the policy like building, plant and machinery, stock also, it is never depreciated. So how the sum insured in LOP is what is that?
So as you have very nicely put, Rastogiji, in these questions, so GP can be calculated, sum insured can be calculated two way. We discussed this earlier also. That one method, old method, which was there, net profit plus standing charge method. The standing charge you can also use along with the fixed charge.
Just hold on, Ashok ji. For the audience, we had put two clauses of definitions. And one is difference basis, one is on output basis. That is a specification number A and a specification number C, which has been copied from consequential loss of tariff, which is erstwhile tariff. And the second definition on the right hand side, the third column, talks about the policy wording, whatever is given in section 2, gross profit. Sir, please continue.
Correct. So there were, like you already explained, so there were two methods to calculate it. We discussed in detail. So if you like, I can quickly once again explain. So standing charge method is, what you do is you take the, at the bottom, not profit, and add back all the fixed cost. And taking care that there are some costs like which are variable, semi-variable. Example, say electricity. Electricity is a typical example of semi-variable cost, that you have got a minimum demand charge, plus on top you pay per unit consumed. So you need to split electricity into two parts. One is variable part, one is fixed part of that. So you add back all the fixed expenditure in net profit. Now, so it was a simple method. It's not a very complicated method, but it created a couple of problems.
Sir, I think I mean, just a humble request. Can we go question to question answers?
Okay.
So what does sum insured covered under LOP cover represent? I mean,
so sum insured is the gross profit which
yes.
Which insurer is the gross profit which insured would want it to be indemnified.
So in the first policy, in the first column, we have written, I mean, the policy defines gross profit by amount which the sum of turnover and the amount of the closing stock shall exceed the sum of the amount of the opening stock and the amount of the specified working
separately. Turnover is disclosed separately, and the and this specified material cost is disclosed separately by the companies. So you don't have to do make
Perfect.
much adjustment. In earlier time, if suppose some partnership firm, etc., are preparing accounts as per the old methods, then possibly you will get this figure separately and you will have to work it out.
And now the second point in that first column.
So then second question is like this, that now the sum of amount of opening stock and the amount of specified working expense. So opening stock, suppose we adjusted already in number 1, then you are left with specified working expenses. So specified working expenses is basically the variable expenditure which are there. So it's a reverse calculation compared to the standing charge method. So you just take
So
the
I will come to
expenditure.
specified working expenses later. And what is this note say, sir?
So example of a specified working expenditure could be examples. Besides the material.
Please.
Besides the materials, you add the things like, let's say, freight and forward, incoming or outgoing. There can be sales commission, example sake, which is a percentage of sales.
Yes.
And so like this, you can take a few more items, which can be a percentage of sales. But every time something is denominated in percentage of sales doesn't mean that that's a variable expenditure. It doesn't mean. So taking one very typical example is the director's commission. So director commission at time could be a percentage of net profit. So directly, indirectly, it becomes a percentage of sales. Right? So, but that's not a variable expenditure. Board doesn't, because that's the maximum which board can declare. Board can declare actually 0 in that case. So it's a discretionary spend. It is not nothing to do with the quantity of sales which you do. All right. So then,
Perfect,
question note 1. So note 1 is very simple. It's the accounting definition that as per accounting standards, whatever is, that's how you value your opening and closing inventory. And sometimes, people can have argument that there are some write-offs in the book, like depreciation, goodwill. There could be preliminary expenditure written off. So whether those are those should be considered in while valuing the stocks or not. So this policy is very specific that depreciation has to be added back for valuing the stock, which is disclosed after sales, other income, less material, less employee benefit, less depreciation, less other expenditure gives you net profit. That is profit before tax. You don't have to go profit after tax. You start with profit before tax is the net profit. And you add back into that.
That is what normally we say PBIT. Is it correct?
These definitions in different textbook, you will get different definitions. So at this moment, for practical purposes, those who are in India, at this moment, you consider what we call profit before tax, PBT.
Profit before tax.
You start from there, make the adjustment for other income, which is not connected, which we discussed earlier, make adjustment for that. Then you add back the fixed costs. So what will be the typical example of fixed costs then, or standing charge, what we are calling? These also are known as period cost. There could be 1 or 2 more names for fixed cost. So how do you add back the fixed cost? So one typical example which appears straight away on the P&L main page itself. So your employee benefit costs are typically fixed cost. Because you don't fire your people, even if you are going out for 6 months, 8 months, 12 months out of production, you will not remove your people. And now good companies will not even remove their contract labor actually, because they consider that those guys also have to run their household. They've been coming to the company, helping the company. So many companies will not remove even temporary staff in that period as a business policy. So employee schedule you can consider as completely as fixed cost. Depreciation is a fixed cost completely.
Ashokji, you are talking of fixed cost, where it is mentioned here is standing charges. Are they synonyms?
They are synonyms. As I explained, fixed cost, period cost, standing charge, these are all synonyms of each other. So you add back the depreciation, finance cost, except to the extent of working capital, also is a fixed cost. Actually, you don't have to worry about even working capital interest, because server will make at the end an adjustment for saving in fixed cost. So that also should be considered fixed cost. Then you have got a bigger schedule of, so if you allow me, I can just show one typical example of on the sheet. I'm just showing you one example of a fixed this.
Just let me first come out of this.
Then you have got rent. Rent is more or less a fixed expenditure. You got repair and maintenance of building. I would consider more or less repair and maintenance as more or less fixed cost. But at times, very, very unique cases you could have where this is not a fixed cost, but depending on your output, you have to maintain the machines.
So it's a mix of fixed and variable. Variable portion may be towards maintenance of the idle machines and idle building. That minimum maintenance expenses can be taken as variable. Is it correct?
Yeah. But mostly it will tend towards fixed cost.
Yes.
It will
Primarily
tend towards
it is
fixed cost. So some small percentage will go into variable. Okay. Then consumption of stores and spare part. This is again like repair and maintenance. Nothing is more or less like that. Then you go to insurance. So insurance is a fixed cost. Only some portion may be variable. Example, say marine insurance premium can be variable. But marine, it's we have a 007 rate in India, so it's a very little amount. Surveyor will not even waste time to find out saving in that. Rates and taxes is a fixed cost. Bank charges, more or less fixed cost. Traveling and conveyance is a fixed cost. Now, freight and forwarding charges is a variable cost. So it's a variable cost because it depends on your either sales or purchase. Now, there is sometimes you sell the plant and machinery. So loss and sale of plant and machinery and equipment, it's a fixed cost. Commission on sales, it's a variable cost. Because generally speaking, commission on sales you pay as a fixed percentage of sales. Now, CSR expenditure, I saw in chat box somebody asked this question. So CSR expenditure again is it's created out of it's a kind of appropriation out of your profit. So you should consider CSR as a fixed cost, not as variable cost. Those denominated as a percentage of your profit.
Net profit, yeah.
Yeah. A provision of doubtful debt, fixed cost. Then bad debt written off is a fixed cost because it's got nothing to do with the sales. Vehicle expenditure more or less fixed cost unless it includes vehicle which you are using for transportation of goods. But generally vehicle expenditure, as you see in the balance sheets of the company, vehicle expenditure generally is the car, etc., which are used by the company. Legal and professional fee is a fixed cost. General expenditure, one should analyze if it's a big item, like in this balance sheet, it is a reasonably large item. One can further break it down, see it, if there is any variable expenditure in that. Auditor, director sitting fee, I already discussed. These are fixed costs. Other director commission, though denominated again as a percentage of profit, like CSR, you should consider it as fixed cost. And foreign exchange loss, it's a financial transaction. So you consider this as a fixed cost in this case. So I have given you
Yes.
heads on a typical.
Thank you for this clarity of how the items of the profit and loss account and how they can be treated and what is the logic behind that.
So if you are a broker, I will still ask you to spend some time with your client and understand what goes inside this in these accounts. But don't
Perfect,
go.
Sir. Can you stop sharing?
Yeah. All right.
So the another question while I share this thing is we have talked about two type of, one is difference method and second is the net profit plus standing charges, that is addition methods normally we talk about. So what does it mean? How it is differed from one to another? Any of you can take that
You're
question.
taking this, right?
Yeah, Hari. So what is the difference between difference method and addition method? That is what we normally say. And what is that? Can you explain in simple way?
in addition method, you take the net profit from the balance sheet, and then whatever standing charges are there, you need to identify them. So like Ashok pointed out now, so you need to identify and then add these two together, then you arrive at the gross profit. This is one method of doing it. The difference method is you reduce the value of variable expenses from the sales turnover, and also the difference in stock from the sale value of the turnover. Then you arrive at the gross profit. Why are we coming to gross profit? Because we know that there are some variable expenses. If there are no variable expenses, then the reduction in turnover itself becomes a LOP loss.
Like windmill.
So if you have an office or a type of business in which there is no variable expenses at all, entire like consulting companies or hardly any variable expenses. Everything is completely the total turnover itself represents, if there is a reduction in turnover, that itself is the loss. So it becomes very simple to calculate. But in case of manufacturing companies or companies where there is an input going into the business, and that input comes down because of, when there is a loss, then that you don't need to provide that input. So the input cost is saved. So you have to remove that input cost or the variable cost from the turnover to arrive at the gross profit. If you don't do that, then you will be paying something which the client did not lose. So you will be violating the principle of indemnity, right? So that is why we need to remove the variable cost from the turnover and arrive at the gross profit. Now we have these two methods. Now the advantage with the variable, difference method is that all standing charges are automatically included. So you won't miss out on anything. So whatever is considered as variable will be taken out, and the rest everything is considered by default as standing charges. So you don't miss out on anything because in the addition method, if you don't include everything, then there is a penalty for that. There will be a memo to the policy which penalizes you. But then in difference method, that is not there. All the standing charges are deemed to be covered. So difference method is worldwide nowadays used as a standard method. Most of the policies are nowadays on difference method. Very few policies are still on the addition method.
Perfect. So both are same. It depends, but nowadays the practice is that difference method is more comprehensive, more easy to calculate, and it does not eliminate any standing charges. It is automatically covered all standing charges. Hence, this method is preferred. Just to add,
just one more point
yes, please.
here.
Yes.
See, there is, as Ashok was saying earlier, there are some, the policy assumes that either it is standing charge or it is a variable expense. There is nothing like a semi-variable or semi-standing kind of thing, but there could be some expenses like that. It will have a component of variable also, but that doesn't matter. I mean, when you adjust the loss, even if at the time of adjustment, any savings in standing charges, if there is a semi-variable component, that will come in as a saving in standing charges, and that will not be paid as part of the claim. But the policy requires you to insure all of them for the purpose of full insurance.
Just to add, so consequential loss tariff, that is FLOP, normally gives you both the options, whether you can go, rather three options, specification A, B, and C. Whereas IAR policy gives only difference basis options. So in certain insurance policies, I have seen, and it is printed in the schedule as well. In IR policy section 2, net profit plus standing charges, that is incorrect technically, because until unless the policy does not give you option of addition method, policy gives you only one option, that is what mentioned here, that gross profit is on difference basis. The policy, though you have touched that point very elaborately. So working expenses word it used. So there are three words which are being used in this below the screen. You can see specified working expenses. The second point says insured standing charges. In IR policy, it talks about uninsured working expenses. So whether they are same synonyms and whether there is difference and what is that? Can you little bit elaborate?
So I think we have all we have discussed this in now great detail, this whole thing. So we go with specified working expenditure. I think you have already given the specified working expenditure examples you have already given on the left side.
So basically, it is synonyms to variable.
As one can see, these are all variable, but except that item number 3, if you saw, item number 3 was like it has a fixed portion which can be excluded out of calculations. Similarly,
that is minimum demand charges you are talking of, no?
Minimum demand charge.
Basically, yes.
And like bad debt, I'll have a little bit different view on bad debt. Bad debt, I'll consider it as a more fixed charge because it's independent of production. Bad debt is a completely different decision. It's a financing decision for anybody. So I will not include bad debt in the specified working expenditure.
No, but I am putting my logic to it, bad debt. Until less I have sale, I will not have bad debt. Is it correct? So
No, but it
is related to the
because you have sale, because you have sale doesn't mean that you will have bad debt.
Yeah, variable may be 0. So if bad debt is 0, then variable things will not come. But suppose bad debt is being reflected in my balance sheet.
Bad debt is always an accounting decision. When to write off, how much to write off is accounting decision. It's more appropriation than a. See, take an example. You can't do business without packing material. Example, say you take next item number 6. Packing material will have to be there always.
Yes.
But bad debt not necessary. So similarly, if you take in this another example which is coming here, discount allowed is okay. Any other? I saw one more item, consumable store. The store we had already seen that store also could be variable versus fixed. So point I'm saying is this is a question of fact. Actually, to come to conclusion, any item to be included actually is a question of fact, which you should spend some time with your client and discuss with him how does your business operate, and then make decisions.
So,
because once you make these decisions, there is a refund of premium clause on the policy, which we'll discuss in greater detail later on. So you give a C certificate for that. Better that you are consistent at every stage.
Yes, sir. Then what is insured standing charges? Is the same or different?
We discuss that in great detail. Fixed charges is insured standing charges.
So, no, my question is specified working expenses is variable. Is it correct?
Right.
And insured standing charges is the fixed charges.
So let us put it this way to solve your question. Every expenditure either will go into the left column or in the right column. That is the middle column.
Perfect.
Either in the left side, it will go into the right side. So, all right.
Yes. So what does it mean, uninsured working expenses? What do you mean by that in IR policy?
The following variable expenses of the business are not covered by the policy. So though they are working expenditure, means variable expenditure, right? So the way they are trying to define to come to gross profit is by reducing sales minus variable cost. I think we have discussed this in great detail.
Yeah,
you can make a claim for this.
So it means specified working expenses is synonyms of uninsured working expenses. It is correct?
Sorry, you are saying specified working expenditure is the following variable expenses of the turnover and purchase taxes are not covered by this policy because you would have anyway excluded this. What you are covering is actually GP. What the insurance company is actually covering is the GP basically.
No. My question is simple. Whether my echo is coming somewhere, I don't know how. Echo is coming to you all or to me only?
A little bit to me also.
I do not know how. Can the technical team can help us? My question is specified working uninsured working expenses, it is the same thing or different thing?
No, if you see that is because once you have done purchases, all specified working expenditure is your all purchases.
So basically, they are same things. They are synonyms. Is it correct?
Yeah.
The statement?
Yes.
Correct. More or less looking like they are similar. Yeah.
Yes. That is what I wanted to ask because
Yeah. So both
sometimes
of
the
them are
word.
looking variable. So you are removing the variable expenditure out of basically in the nature of variable expenses.
So you have answered also the last question: how to deal with expenses of production, like production incentive, contract labor expenses, working capital interest in arriving gross profit. Is it correct? Or
Yeah.
you want to add, or Hari want to add something?
Just I want to
I
add
think
this
it's
that
already been
better you include all of this in the for insurance purpose, and what would happen is that surveyor will make a adjustment for the saving in fixed cost if it happens. If it doesn't happen, doesn't happen.
Hari, you wanted to say something?
See, you always err on the side of caution. So if you're not sure about how the accounting behavior of a particular cost item will be at the time of loss, then include it as a fixed cost. So you insure it. You might lose some premium on insurance, but then at least you are fully protected at the time of loss. Everything cannot be predicted in terms of how the certain accounting heads will behave at the time of loss. Sometimes the behavior may be different. So it is not predictable. So always err on the side of caution.
Perfect. So we have understood the turnover, output, we have understood gross profit, we have understood net profit, we have understood variable working expenses, we have understood fixed cost or standing charges. Now we move further. There is another word called indemnity period. This is unique to BI policies only. So indemnity period, this time reading it out in LOP policy, that is in tariff, consequential loss tariff. The period beginning with the occurrence of the damage and ending not later than so and so months thereafter, during which the results of the business shall be affected in consequence of the damage. The word is, they are defined a period. After the occurrence, 0 date is occurrence, and which ends whatever is specified. Suppose I mention 12 months, during which the results of the business. So it is talking about result of the business shall be affected in consequence of the damage. So suppose fire has happened, due to that my business has been interrupted. So it does not say anything about reinstatement of the physical assets. It does say about the results of the business. Whereas if I go to indemnity period under IAR policy, the period beginning with the occurrence, again 0 date is occurrence of loss or destruction or damage, and ending not later than the maximum indemnity period. Maximum word should be understood in indemnity period in FLOP also. Then the maximum indemnity period thereafter, during which the results of the business shall be affected in consequence thereof. That is the same thing. Again, some echo is coming. It is coming to you also now?
Yeah. Yeah, that is okay. You can proceed.
Yeah, provided some eco-technical guys, if you can help us, provided always the company is not liable for the amount equivalent to the rate of gross profit applied to the standard turnover during the policy period during the period of time exclusion of days stayed in the schedule. So I will not take second paragraph now, but I am talking of first paragraph. So my question, which has been framed by my colleague Weber, please explain indemnity period defined in the policy wording. What factors should we consider in determining policy indemnity period?
Yeah. So the indemnity period refers to the period during which the business remains affected. How does the business get affected? So there is a machinery. Assume there is a machinery which is damaged. So the machinery has to be first repaired. So the repair period is there, or the reinstatement period of the machinery is there. But even after the machinery is repaired, it may not start production immediately up to the full level from the day one it is started. So maybe some time it will take for that machine to achieve full production. And then also there could be some time which will be taken to get the business back to the condition in which it was prior to the loss. So this entire period, which is the period of restoration of the machinery and the period of recoupment to the previous levels of business activity, that period is considered as the indemnity period. There is a common misconception in the market that the indemnity period means the period of restoration only. The policy doesn't talk about that. The policy talks holistically.
So you told business activity word you used.
Yeah.
So, I mean, I give you various examples. Suppose my building or plant and machinery has been restarted.
Yeah.
There is in certain factories, certain type of occupancies, the process by which my output reached to the level which it was before the occurrence. Is it correct? That is what we are talking about?
No, after the output has been reached to the previous level also, there can be some impact on the business. The business, there is a logistics, supply logistics, which is there. There could be other constraints. You have produced, but then there are other things which the business depends on. So doesn't mean this level of production immediately you will be able to produce because you have to evacuate also, right, using the supply chain. So essentially it's very difficult to say that this is the period. So what is generally done is you take the entire financial year or the maximum indemnity period and see how much is what is the period during which this impact has been felt in the balance sheet. And that is your indemnity period. That's how.
But Hari, sometime it happens. Suppose I am out of the business for 6 months due to fire.
Yeah.
And I lose my few of the clients permanently.
Yeah.
So my turnover is definitely going to affect, and that client may not come at all. So whether my indemnity period will continue?
See, the policy doesn't say any exclusion, saying that loss of market or that is excluded or something. The business has to be affected. Your business got affected, that's it. How long did your business get affected? That is the consideration you should look at. In case of American wording, it is restoration period. There is no concept of indemnity period in American business interruption wording. They call it a time element wording. We follow the British system, which is gross profit and indemnity period. So these are two different concepts which are there.
Because here the wording says result of the business.
Yeah,
So it is not merely production. I fully agree with you. Results of the business is much more wider things than production and other activities.
precisely. So that is the point I'm trying to drive. The policy doesn't talk about production, policy doesn't talk about reinstatement, policy doesn't talk about restoration. None of these words are used in the indemnity period. But many people impute these meanings into the indemnity period, which is wrong. All you need to look at is what the definition says. The definition says the business, the period during which the results of the business were affected. That is
Yes.
all you need to look. So how do you,
Exactly.
so you need to look at the balance sheet for the period corresponding to the indemnity period and see how long the business was affected. That is your indemnity. And there is a cap. You don't have to go beyond 12 months or 24 months or 36 months, which is taken in the policy. So you cannot adjust the loss until you have the entire results available with you. So you need to wait for the maximum indemnity period to be over, take out the results, and then do the loss adjustment.
Perfect. Ashok ji, anything you have to say on results of the business? Result of the
I'd like
business.
to add a couple of points on what Hari said.
Yes.
So number one question you asked, customer is permanently lost. Insured will, this is where the surveyor will refuse to make the adjustment. He says this is a consequential to consequential loss. Customer permanent loss, market share permanent loss will not be covered by the policy, number one. Number two point, this maximum indemnity period, you have to wait before the claim can be adjusted. I respectfully, disagree with that view, because the reason is that if you have a 24-month indemnity period and let's say loss is just 3 months, so you can be waiting for 24 months to see if the production is made up, because the production which is made up has to be connected with the loss incident, nothing other than that. So it's clear, and these days, customers have, we are not anymore in when these policies were adopted. Worldwide, there would be shortage of goods and goods, etc. So customers had no choice at that point in time except to wait for the manufacturers to come back in production. But now it's a free competition. A lot more goods are available. So customer don't wait for you. They just import or they just get from another customer, another supplier of material. So any decrease in turnover after, some time has elapsed after the restoration could be due to other factors. So what does it worry for those factors for adjusting the loss? Otherwise, we will end up penalizing the people who are buying longer indemnity periods.
Yes. So beautiful observations from both of you on this. What results of business shall be affected in consequence of the damage, which is directly related with the damage. Both of you have highlighted your point of view, which is relevant. But one thing is very, very clear: it is not directly limited to the restatement of physical construction under material damage sections. So the next question, which is related to this only, the question is like, suppose I take 12 months, I take 6 months, I take 24 months, I take 18 months indemnity period. How the sum insured will be taken? Whether for 6 months, my gross profit, annual gross profit is suppose 365 or 100 crores. So if I'm going for 6 month indemnity period or 18 months indemnity period, it should be 50 and 150, or what should be my sum insured?
Sum insured for the purpose of any period less than 1 year, 12 months, will be the annual GP itself. And for any period more than 12 months, it will be increased on a proportionate basis. So if you have 18 months indemnity period, then the annual GP will be multiplied by 1.5. If it is 24 months, it will be multiplied by 2. So that's how the sum insured needs to be declared. Sum insured will never be less than the annual GP. If the indemnity period is more than 12 months, it will be multiplied. Otherwise, it will be the annual GP.
So the minimum, irrespective of my indemnity period, suppose my indemnity period I up for 6 months, even then my sum insured will be 100 crore in that example.
Yeah.
But if it is 18 months, it will be 150. If it is 24 months, it will be 200. If it is 36 months, it will be 300 crores.
Yes.
Correct?
That's
So that is what. Sir, please.
Sorry, I'll add just one more point in this.
Yes.
Now there is another issue. So how do you determine this? Examples like you said 2 years is suppose 200. Examples like annual is 100. Now your problem is little different in this. You are buying suppose policy on 1/4/24 argument's sake, or next renewal season we are starting say 1/4/25. So you are going to buy the policy in 1/4/25, right? With the indemnity period of 24 months. Now your problem is like this, that you are looking at the accounts which are available to you are only 23-24 accounts, 24-25 accounts that also partially available to you, because final accounts will come up in June for 24-25 also. And you have a situation, your policy is a 12-month policy, so which means you can have a loss from 1/4/25 to 31/3/26 any point in time. So suppose you had 24-month indemnity and your loss is on 31/3/26, you suffer the loss last day. Then your 24-month will start from 1/4/26 to 31/3/7 and 28.
Yes.
So you are sitting now in 24, discussing in January month of 25, possibly with your client. And so you need to basically look at next 3 years business plan of the client. And based on 24 months, if you are going to choose, then choose the sum insured business plan of the client between 26, 26, 27, 27, 28. Add those two up and then choose your 24 months. Then that's the sum insured for 24 months.
Beautifully explained. Just I will reiterate whatever Ashok Jain ji has told. Is I take a policy, suppose 1st January 25, I take the policy as example he was giving. And I have taken two methods I am going for, 12 months indemnity period and 24 months indemnity period I have taken. So the point becomes, loss happens suppose on 31st December 24, the last day of the policy, theoretically. And it's a actually affected period is suppose 6 months. One example, I take 6 months, and one example, I take 18 months. So LOP is always a futuristic loss. So whatever loss I would have incurred from 1st January 25, that is 1st January 26, that is after end of the policy, because loss has happened on 31st December 25, last day of the policy. Hence, my results of next 6 months till June 26, it will be affected. So my sum insured should commensurate with the projected of 26 calendar years. Number one. If it is 18 months, it should have 26 calendar year and 27 half year at least. If I have taken 24 months and unfortunately it becomes 24 months, then basically 26 and 27, whatever is projection for next 2 years, it has to be taken if I want correct indemnity without any underinsurance aspect therein. That's why there is a 33% in IAR policy and 50% in normal FLOP policy. Refund provision is here. So always take this thing in account. Normally, what we do is previous year's profit and loss account we take and we determine. So we are 3 years back, basically, practically 3 years back. So all the questions, all the feedback on this aspect is also welcome. We can debate on that. What should be my sum insured, whether sum insured is practically linked with my indemnity period, the larger the indemnity period, futuristic sum insured has to be projected accordingly. The last question to both of you is because it is already 6 minutes are over. So, question in this only, which is out of course here, is indemnity period I have selected 24 months, but my material damage problem talks about 12 months of restatement. Why it should be 4 months automatically? If I am envisaging that my plant will be reinstated and my business will be reinstated in 24 months, so at least restatement period should not be indemnity period. Your comments.
See, these policies were not decided.
Your voice is not coming. Or
is it audible?
yes, it is audible. Yes.
I agree with you. Because the indemnity period is a choice of the insured. If he by default the policy is annual policy, but if you want to have 24 months, you could take that. But corresponding benefit is not given in the material damage section, because material damage section it gives 12 months. To ensure that the insured does the reinstatement as soon as possible. Now, if the 12 months period under the material damage section is not considered sufficient, then you can ask for an extension of the period. And the insurance company is supposed to grant it if it is a genuine request. But if you make the reinstatement period as 24 months, corresponding to the BI period, indemnity period of 24 months, then even for small losses, the insured will not take any, which is, if there is no BI and only MD loss is there, and you have given 24 months reinstatement period, then he will take his own time in reinstating, which will be against the insurance company. So that is why there are separate reinstatement period in an MT section and different period of indemnity in the BI section. Those are not interrelated in that sense. Hope I am making sense.
Yes, to me at least you are making sense, full sense.
Thank you.
You want to add something, Ashok ji?
No, it's good.
Perfect. So let me go to the questions in chat box. Though you had referred, Ashok ji, the first question, interest on working capital is fixed or variable. And the another question related to this is CSR is fixed expenses or variable expenses. Ashok ji, just to repeat.
We discussed this, that I will consider, and like Hari said also, that you need to be conservative while fixing up some insured. So I will consider both of them in the fixed cost, both of these expenditure. Because try and understand that your indemnity, your period of loss could be 15 days or it could be one whole year. Basically, 12-month policy. So if you were to remove for 15 days, it will not make much difference. But one whole year, it makes some difference in the premium and the calculations of the loss. But I will consider in fixed. We generally like to do that.
Yes, perfectly, because you do not know what with the real affected indemnity period will be there. Second question, if due to fire, production is stopped for 3 months, but sufficient stock was there in the warehouse, so there is no loss in turnover during that period. If the policy is on turnover basis, then how the claim will be settled? Hariji, simple question. Yeah.
That is this accumulated loss, stock losses there for taking care of it. But I think we need not take it now, right? I mean, there is a...
Yeah, we will be taking, so to answer your question, as rightly put up by Mr. Hari, this point is well taken by accumulation of a stock loss, where the stock turnover is maintained by utilizing the finished stock which is accumulated before the loss. we will take all these clauses in the subsequent webinars. So there your answer will be given in detail. That answer has been given by Mr. Vivek Tripathi also. Sir, please share the complete list of variable and fixed expenses charges if possible. See, it differs. Ashok ji, you can take it.
Okay, we can share it. We discussed that in detail, but we can share, I don't know, in the question and answer, we can take it up and share the list. What we consider fixed, what we consider variable.
See, list we will definitely share with you, but sometimes it is a standard list of expenses which can be segmented into variable to fixed. But depending on type of industry, depending on type of accounting practice, it may differ here and there. Jain sir, if we calculate GP by using both methods, the GP percentage coming is same. That is a statement or that is a question, comment you can do.
Yeah, so also
Ashok Jain ji has replied already, but it's too fast.
So both methods lead to same result actually.
Yes.
They lead to different results.
Yes, perfect. How is usually the case of damage to public utility? That question we will take while going for FOES. Failure of essential services, that is a clause, that is a wordings, add-on covers. What should be the date of restoration? Merely resumption of electricity or resumptions of insured business to normalcy after that. So there is a provision under FOES clause we will take in detail in subsequent webinar. What is the best method of arriving at sum insured? Turnover basis or GP plus standing charges? Hariji.
Best method of arriving at sum insured, turnover basis or GP plus standing charge?
And it should be addition method or actually this question itself is
not correctly framed.
Not correct. You can explain little bit about what is addition method and what is
as earlier explained, addition method, you identify the standing charges, you add the net profit, and you arrive at the GP. In the difference method, which is more popularly used nowadays in the world, you take the turnover and reduce the variable expenses and adjust for the change in stock. You get the gross profit. Both are two approaches, but the result has to be the same. If correctly done, then there cannot be any difference between the two. But differences do happen because people may not identify the standing charges correctly or the specified working expenses correctly. So there can be differences due to the mistakes in identification. Otherwise, there is no difference in the final outcome, even if you use one method or the other. Both are two different approaches to arriving at the same.
Perfect. So you can go by flight, you can go by train from Delhi to Bombay.
Yeah.
And I mean the cost and the time consumed may be different, but you will land in Bombay itself.
Yeah, same.
So this is what it is. So this is very enlightening and helpful. So thank you to both the panelists. Have one query though. Sir, though we are referring to the tariff, wordings have been de-tariff. Yes, you are right, dear. If we notice, insurer now quotes subjecting the terms and condition on insurance wordings. Do we have any clarity on which insurers have filed variable products and how they vary from erstwhile tariff? So he wants to know, yes, I agree with you, Rishabh-ji, that de-tariffing of policy wording has happened in last March or some time there, almost 9 months or 10 months before. But still, if there are new wordings by insurer, Hariji and Ashok-ji, if you can highlight on that point.
On this wordings, I don't know whether any wordings have been filed or approved. As far as LOP is concerned, the wordings are worldwide standard. There is no new wording which is there, except for probably some add-on covers. Otherwise, the BI section wordings is standard across the world. There are two forms, American form and UK form. Otherwise, they are standard across the world.
Perfect. So, Hariji, next question is addressed to you. Indemnity period definitions. If there is no market demand, then what?
So that gets adjusted in the lots adjustment. There is a trend adjustment, which we will come to later.
Yes.
So indemnity period, you are saying that your business got affected by the loss. So there was a loss and you couldn't sell. But did you really couldn't sell because of the loss, or you couldn't sell because of other reasons? So that is something which the loss adjuster would look at the time of loss. But indemnity period is something which says that your business has to be affected following the loss. Right.
Yeah,
So
perfect.
let me just supplement, Hari. Let me just supplement, Hari. So you know, there was one question relating to warehouse also went up earlier.
Yeah.
Warehouse stock adjustment clause.
Yes.
So first we have to understand that this policy is an indemnity policy. It's not a benefit policy. So you have to actually suffer a loss before you can be indemnified. Okay. So so there is no market demand. Even if your plant was on, you would not have
Your
been able
voice
to
is,
sell the goods in the market. Then obviously there is no claim in the policy.
your voice was not audible, at least to me.
I'm saying, I'll just repeat, I think some connection problem. So voice was, with indemnity policy. So if you have not suffered a loss, policy will not pay for the loss. So if there's no market, you would not have anyway, even if your plant was on, you would not have sold anything in the market or produced anything. So there's no claim in the policy in that event.
Perfect. So basically, Mr. Vivek, is it correct? Mr. Vivek. So basically, there is a trade clause or bracketed clause in consequential loss tariff, or trade clause, you can say, in IAR policy, which talks about before and after the loss. What would have been the business? What do you have with loss? The same thing Mr. Ashok Jain has told. What you have had at loss is being paid under the policy. If there is no loss, no market, but there can be argument. I could have produced and could have sold subsequently when the market becomes that type of argument also can be justified and can be valid for that type of things. So if there is a cyclic market or there is a seasonal market, these type of things may be there, like sugarcane, like fireworks, and so on and so forth. So many subjectivity comes into play while determining the loss. So all these comes under trained. Trained is a very complicated subject, and we will take that things in detail. The next question is from Priya. Can you please give example of MLOP losses and indemnity period? Anybody can take it. Any of you.
MLOP and FLOP, the FLOP remains, essentially the concept is the same. In FLOP, a fire or fire and allied perils, one of these operates. But in case of MLOP, it's limited to a particular machine. A machinery gets damaged, and as a result of that, the plant gets affected. So other than that, there is very little difference between the two.
Perfect. Next question is on deductible. Though deductible we are not touching, I am just reading it. Yeah. On deductible part, can we apply daily average value of loss in the state of GP? So
I think again, it's a complex thing. We can
lot many permutation combinations depending on the context, and so many things will come into. There is no uniform yes or no for these things, depending on I think Vivek Tripathi ji has put some statement. Proportionate method does not adjust the trend. At the time of considering the GP for more than 12 months, you must take care of trend. Ashok sir, CSR is part of net profit. That is a question I am asking also. Ashok Sarji, CSR is part of net profit or not? It is before
We
net
discuss-
profit or after net profit?
We discussed it. CSR, though now it's very interesting. CSR, the way it has come up now in India, it's 2% of profit you need to declare. Right, so there's a calculation. You reduce CSR, then it will be infinite loop actually. So there's a mathematics to do it, but it's still is a kind of appropriation of the profit rather than a fixed cost. So I will insure it, because if you really think in sales minus specified working the difference basis, CSR would not enter into the calculations. Very simple way to see is that.
Perfect. So next question is, in LOP, IP is 12 months, but the damaged machinery is not readily available in the market and cross 12 months of indemnity period. So restatement has not been done practically. What are the way out to cover the extended additional IP? Means they have opted for 12 months indemnity period, but reinstatement has not been done in 12 months. So is there any way to cover this extended additional IP at the time of claim, I presume?
Okay, so we discussed this quite in detail, that you need to understand your business well and need to sit with the client and understand where it could take the maximum time. So there are a lot of markers when you know that it can exceed 12 months. That's the precise reason why many companies take 24 months, 36 months as the indemnity period. So, but after the loss, I'm afraid then you'll have to go to ART market, alternative market, where they'll cover your past losses. Because loss attaches the day incident happened in your policy. After that, the policy is triggered. I don't think you can alter the term after that.
Yeah, it is just like increasing the sum insured after the claim has occurred. So
Correct.
the insurer will be, so that defeats the main purpose of insurance itself. So if everybody is permitted to take increase the sum insured after a loss has occurred, then people would do that. And people will go for a lesser indemnity period. And then once the loss has happened, then they will ask for increasing the indemnity period. Then the insurer will go out of business, right? So that cannot happen.
Perfect. So next question is, in departmental clause, access applicability to only particular department and whole. This question we will take while dealing with departmental clause. That is a very important clause, and we don't want to give you half-cooked answer. We will deal with it in subsequent webinar, and then we will answer your questions. The last question is from Mr. Darshan Singh Minocha. Again, two voices are coming. Technical team, can you support us? What about fixed charges, that is standing charges, even when there is no market sales possible due to market conditions? Will these be part of claim or not? I think question any of you can take.
So that, see, this is something which we discussed. So, I mean, just because the insured suffered a loss, it has to be paid. That is not how LOP policy works. Insured has to suffer a loss because he is unable to sell due to the reasons of loss happening at the premises. If he even if he would have produced, he would not have sold, then he is not suffering any loss. So that is a loss which he would have bound to have incurred. Right. So that cannot be paid, and that is not the purpose of insurance. So it is similar to a situation. Say, suppose if there is a hotel and there is a flood, and the hotel has got damaged. But along with the hotel, the surrounding areas also have got damaged. Now, even if the hotel was not damaged, still people would not have come because there is no way to reach the hotel. So this is called the wide area damage. where the damage is not isolated to the insured premise only, but it is a bigger damage. So you cannot say that you suffered a loss solely due to the event happening at your premises. Even if your premises were intact, then also you would have suffered a loss. So those kind of losses will not be considered under LOP. You have to demonstrate that your loss is due to the your financial loss or the BI loss is solely due to the event happening at your premises.
Yes, basically, I take it as a very simple formula. If that loss, whatever loss we are discussing under the policy, would not happen. So if that loss was not there, like in this example, there is no market, then also fixed cost he has to bear. The same thing is here. So the loss has not aggravated his expenses, his outgo. If the loss would have not been there, whatever he is losing is the status quo, which has nothing to do with the loss. So if loss has aggravated, has worked as a catalyst to increase his financial losses of any kind of related to that loss, then only that is covered under the policy. So same thing happens for fixed variable expenses, though there is a concept well explained by both the panelists. If my production would have not been there, or my sale would have been not there, what could have been my savings? What expenses I could have reduced 100%? What expenses I would have reduced partially? Like my raw material consumption would have reduced 100%. My power would have been reduced from 100% to minimum demand charges. So that becomes a litmus test. Let me put that scenario, that test, litmus test to each and every expenses and income. And then I arrive to that concept of whatever additional loss or savings I'm having arising out of this loss, which has happened now. So basically, this is a futuristic things. That's why LOP is loss of profit or business interruption is much more complicated than the normal material damage losses. And even understanding of, there are few people, unfortunately, insurance industry, in Indian insurance industry, and surveyors also, who really understand, who apply their mind to those business situations, because you have to work like a business manager, as a surveyor, as an insurance company, as a broker, as if you are the entrepreneur. Anyway, coming back, so thank you very much, both the panelists, Mr. R.K. Hari, Ashok Jain ji. You had done your best while explaining us turnover, output, what should be my sum insured, what is gross profit, what is difference basis, what is additional basis, what is variable expenses, what is uninsured working expenses, what is insured working expenses, what is standing charges, and what is my indemnity period, how the indemnity period should be selected, how the sum insured should be selected. If my indemnity period is more, it should be projected 1 year, 2 years, 3 years down the line. And that's why there is a refund provision also there in the policy. So thank you very much for all the efforts and all the time you have spent. And thank you very much, entire audience. Only it is you who motivates us to come every second and fourth Saturday before you. And I, on the behalf of IBI, also request you to basically give the feedback so that we can make this program more effective and useful for all of us. And thank you very much. If Ashok ji and Hari ji wants to say something.
I'd like to thank Anand and Vibhav from your office, both of them. Anand works a lot. He worked quite hard to make these programs go on.
Yes, definitely.
Thank you very much.
Thank
Thanks
you.
for the support staff. Thank you very much.
All right.
Thank you.
Bye.
Namaskar.
Yeah.
Bye.